Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to. And in today's video, we are going to dissect a multitude of different articles regarding SoFi Technologies, Tesla, Amazon, Meta Platforms, and Mullen Stock, but not necessarily in that order. First, we're going to analyze an article regarding SoFi Technologies and how they have had fantastic upbeat performance, which in turn will positively affect their overall stock price. After that, we're going to move on and talk about Tesla's TSLA shares and how they are somewhat undervalued right now, where many professionals believe the current Tesla share price could have a gigantic rebound as high as $436 according to some estimates. So if you are an investor into Tesla and you have their TSLA shares, this is going to be the video for you. Next up, after we talk about Tesla, we're going to dive into another electric vehicle company, and that would be Mullen, ticker symbol MULN, where Mullen Automotive has a catalyst coming up on November 30th. But even if this catalyst has already passed by the time you are watching this video, there's going to be very large news updates pertaining to the last video that I made on Mullen that you would definitely want to be informed about, which will dictate whether or not this is a good company to hold or not, in my personal educated opinion. Then after that, we're going to talk about Meta Platforms, formerly known as Facebook, and how some Meta Platforms workers hijacked and took over some users' accounts, and then they charged those customers to pay them personally, so the Meta Platform employee would then give them access back to their account. So essentially they are hijacking these accounts and then wanting the person to pay them personally so they can get their account back, and that is very bad PR for this overall company. But it does beg the question. The META share price has pulled back tremendously, which I think is a good buying opportunity. So we're going to be going over a few facts on whether or not this is a good company to buy right now, considering it's trading at a huge discount based upon the current macroeconomic environment. Then lastly, we're going to talk about Amazon stock and how many professionals believe it is a buying opportunity as of right now to hold for the long term. So if you want more news updates just like this one on a plethora of various companies and the best stocks to buy, go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. So first, we're going to start off with the fintech company or financial technology company named SoFi Technologies, which essentially operates as a completely digital bank by giving their consumers access to an all-in-one inclusive digital app which has anything on it that they could possibly need in terms of financial services and or financial products. The great news about SoFi Technologies is that recently, for this year, the company and management has increased their full year guidance for the third time in a row, despite the challenging macroeconomic environment. This means essentially that SoFi Technologies has either increased their overall amount of revenue that they're supposed to bring in for the year, or their earnings per share for 2022, which is absolutely amazing. And they have increased these particular forecasts 3 different times, and this leads us to believe that the company is rapidly growing, and that is backed by pure data. Nonetheless, despite this very good news about SoFi Technologies rapidly scaling their business, the stock price has fallen around 69% year to date because investors are not only very fearful of even a deeper, darker recession, but also rising interest rates and extremely high inflation. On top of that, the SoFi stock price is down because 4 Democrat lawmakers on the Senate Banking Committee have urged the Fed and the federal regulators to review SoFi's crypto trading activities, which we addressed in the last video. So if you don't know what I'm talking about there, go and finish this video and then click on the SoFi video before this video so you know what I'm talking about. So what do we mean by SoFi growing extremely rapidly? Well, for instance, their total members have grown by around 61%, and they're growing their overall customers despite home loan originations decreasing, rising interest rates, and the negative impact that the economy is having on their overall loan business. To make matters even more impressive is that SoFi is clearly fighting uphill because despite this company originally being a student loan refinancing company, the student loan moratorium said that various people who have student loan debt don't need to pay on their debt and that their debt will not accrue interest until 2023 as of right now. But this just led to SoFi diversifying the revenue streams, which has made the company rapidly grow. On top of that, we see a KBW analyst saying that SoFi's banking business has been the true engine beside their solid results, and that they have a very strong balance sheet and loan origination capacity. He said it's going to be difficult for the stock price to sustain its current stock price and not fall, considering the current negative macroeconomic environment, which is pulling all stock prices down and causing the stock market to lose its value, but he believes that once the economy recovers, this company will surge in price, and that's what I have been saying probably for the last 3 months, and as of right now, he has a stock price target of close to $6 for this company when it's currently trading at around $4 to $5. Many people believe it's going to fall to around $3, and then management will implement a reverse stock split, but that is yet to be seen. This has led various professionals to issue buy and hold ratings for this company, but no sell ratings as of right now, with the average price target coming in at $7.86, even though the current stock price is hovering between $4 and $5, so clearly there's a lot of upside for this particular stock. The low end price target is $6, and even the lowest end bearish negative critic is saying that this company is undervalued right now, as long as you're willing to hold this company for the next 1 to 2 years, or until this company becomes profitable at the end of 2024, according to current metrics. So overall, I like SoFi Technologies. I have around a 4% allocation to it, and I am looking forward to the company continuously growing. That leads us to another company which is rapidly growing, which is Tesla. Tesla is an electric vehicle company, but they also are involved with energy storage and energy creation. Right now, the TSLA share price is trading for $168, while professionals believe the company should be trading between $263 and $436 over the next year. Tesla Inc. should rebound in their overall stock price, and the reason why we think that is because their free cash flow has surged lately due to their strong rebound in production and delivery growth in Q3 of 2022. Tesla shares have lost about half of their value due to many economic-related factors, such as the shutdowns of their factory in China, which is only temporary, various supply chain challenges and issues, as well as inflation, which is making the raw materials more expensive for Tesla to produce their vehicles. But despite these very bad headwinds, we can see that Tesla's valuation has become so cheap that it gives investors the potential to not only buy this company at a discount because it's undervalued according to some, but also it gives us the opportunity for this company to rebound and bounce back to its all-time highs, which will fill investors' pockets with a load of money. On top of that, they have very strong growth prospects for the overall electric vehicle industry, which I think is going to be their bread and butter for quite a while. Tesla reported their Q3 2022 results, which were better than expected in terms of their EPS, which is their earnings per share. Their EPS was supposed to come in at around $1 per share, but instead they issued a $1.05 per share EPS, which is very impressive. On top of that, Tesla's production has increased and rebounded almost completely, which is extremely exciting. In Q3 of 2022, Tesla produced 365,923 electric vehicles, according to this article, in the third quarter, which is equivalent to an increase of 42% quarter over quarter. If you want to see on screen right now, you'll see a chart that we have that lists the overall production capacity and models, which would be the Tesla Model S, X, 3, and Y. This would also include their delivery numbers on a quarterly basis, stretching all the way back from 2015 till 2022 in red. For Q4, we don't have red yet for 2022 because we haven't gotten the data for that, but as you can see, there is a huge exponential curve that is happening here for not only their productions, but also Tesla's electric vehicle delivery numbers. As they continuously deliver more electric vehicles, that is going to increase their EPS and revenue, thus making their stock price absolutely explode. So this is very good news for this company. Not to mention that Tesla really does hold their own compared to their competition, which are mainly smaller start-up electric vehicle companies compared to the market cap of Tesla. Tesla's production capacity is their greatest competitive advantage besides their technology, particularly in regards to their Model 3 and their Model Y. And these vehicles also have a decent margin, which is giving Tesla a new baseline level for their free cash flows. And there are estimates where their free cash flows could come in from $2.7 billion to $3.3 billion, which is phenomenal. The reason we're really harking on their production numbers, their delivery numbers, and their free cash flows is because all of these things are interconnected. The more cars you make is the more cars you can sell and deliver, and by doing that, you can increase your overall cash flows. But what are cash flows used for in a company? Well, the reason we want to see strong cash flow in Tesla is because normally companies use free cash flow in one of three main ways. The first way is to pay off debt. The second way is for the company to invest into themselves themselves so they can innovate either their existing technology or offer new products and or electric vehicles in this case. And then the third reason is for a stock buyback program or potentially dividends. Now for me, I don't think that Tesla is going to release a dividend anytime soon, so instead I think that they are going to use this free cash flow to either invest in themselves or usher a stock buyback program, and the majority of analysts and professionals agree with me, because as of right now, it's been hinted at that Elon Musk is playing around with the idea of buying back $5 to $10 billion worth of Tesla stock. This essentially is going to make the stock price increase, and it's going to make it stronger for the overall company, and it also means that Elon Musk believes that right now is a good time to buy Tesla at a discount so he can sell it later at a higher price. This indicates to investors that the company is not only strong and confident in themselves, but they believe that the TSLA share price will continuously increase in price over the long term. So clearly that is a nudge to long-term investors. If you want to read the rest of this phenomenal article, remember that I link my sources in the description if you want to read the full article for yourself, because I just like pulling out the very relevant bits which saves you time and money. The next company we're going to take a look at is none other than Mullen, which is another electric vehicle company, but Mullen is a super startup company, and I've been very critical of this company probably for the last year, but I've only done 3 to 4 videos on them. The reason we're talking about Mullen right now is not only a lot of people are invested in a Mullen, but also because they have a catalyst coming up. Mullen essentially is trying to become an electric vehicle company that has superior technology and range for their electric vehicles, and they also want to make their vehicles technologically advanced and affordable. The company has said multiple times that they are not trying to directly compete with Tesla, and I don't blame them because you honestly can't. Tesla's clearly top dog, but Mullen could hold their own if their business model works out. However, I have a lot of critical things to say about Mullen, but for here, I'm just going to stick to the article. Mullen fans should look and mark their calendar for November 30th. Right now, the MULN share price is trading at 24 cents, while one analyst believes the company could surge to $23. In a past video, I said that this $23 price target is completely false. There is no data backing that $23 price target. But considering this company is a penny stock, what's the chances of this company reaching $1 or $5, which would be a multi-bagger for this company's shareholders? So let's dive into the data right here. Mullen Automotive, ticker symbol MULN, has been falling in their overall share price for multiple reasons. But the main reason is because they have a lot of debt on hand. Now, the company recently actually issued a series of proposals which will be voted on their next shareholder meeting, which is going to be on December 23rd. And this is going to give shareholders a deeper look inside of this company. But as of right now, I personally think that this company is too speculative, and I'm not willing to gamble my money on this extremely risky electric vehicle company. But it goes on. Mullen Automotive is a penny stock right now, trading at only 24 to 23 cents, which is why I said in the last video that the management of this company is most likely going to implement a reverse stock split. And this could range anywhere from a 1-for-2 stock split to a 1-for-25 stock split. I personally think it's going to be on the higher end. They're not going to do a 1-for-2 or a 1-for-5. That would make absolutely no sense to do that. It's going to be over a 1-for-5. But it begs the question, why are they going to do a reverse stock split? The reason why they're going to do a reverse stock split, which is exactly what I said in the last video that they are going to do, is because if they don't get their stock price above $1, they're going to be delisted from indices such as the NASDAQ, the Russell 2000, and the Russell 3000. So essentially, this publicly traded company is not going to be a public company anymore. It's going to be delisted, and you're not going to be able to invest into this company, which is another reason I'm not comfortable investing into this company, because you could literally lose everything. But besides that, what is another major catalyst coming up for this company if you're still listening? Mullen has announced various binding agreements with companies, and one of those companies is going to be Delpak Logistics, which is an Amazon delivery partner. This agreement between Mullen Automotive and Delpak Logistics essentially states that Delpak would purchase up to 600 Mullen Class 2 EV cargo vans over the next year and a half. The vans are supposed to be able to move a payload of over 3,000 pounds, and they could get 200 miles per charge. It's also come out that Mullen was trying to plan to deliver 300 vans to this particular purchaser as soon as November 30th. And this delivery would mark a huge positive catalyst and milestone for Mullen Automotive. However, the problem is that the company doesn't look set to actually release these vehicles. And if they do end up releasing these vehicles to Delpak, and Delpak is not impressed with the vehicles, they could essentially be dissatisfied with the vehicles and cut their overall agreement, or at least renegotiate it or something of that sort. This is going to reflect very negatively on the overall company if that happens. So if you are invested in a Mullen, you better really hope that their Mullen Automotive vehicles, particularly their Class 2 EV cargo vans, are going to be up to snuff. Otherwise, it's going to impact the overall stock price very negatively. But again, if it's very positive news, this could send the stock price absolutely surging. So it really comes down to your own risk tolerance. Up next, we have Meta Platforms, which is in hot water right now, where their META shares have not only plummeted very aggressively, but something has come out which has released very negative PR or public relation about the company. Right now, the share price for Meta shares is $110, which I think is undervalued, but professionals believe the company should be trading between $80 and $392 over the next year, so technically it does fall into that range, but I am buying Meta in the short term because over the long term, this is a phenomenal company. The reason why the bad PR is coming out about this company and why multiple people are selling their shares is not only Meta laying off and firing a plethora of employees, but they are also getting a lot of backlash from some of their employees essentially holding users' accounts hostage until the users pay the employees, and then they will set it free and give those people back their account once they've made a quick buck. This has absolutely been horrific for the stock price and terrible public relations, which has not added to the sentiment surrounding this company, nor their stock price. Overall, I think this is somewhat not a big deal in the sense of, if you have a workforce as large as Meta, you're going to have bad apples in it. But what does this mean for the stock price? Well, honestly, it means that the stock price is trading cheap enough to where people should start buying the company, in my opinion. But always make sure to do your own research or talk to your personal financial advisor. Meta Platforms, formerly known as Facebook, is essentially a technology company that is most known for their apps that they own, particularly social media apps such as Facebook, Instagram, and many others. And Zacks Rank currently has a hold rating on this company, but I'm going to push back on them. I'm going to say this company is a buying opportunity in the sense that investors should start nibbling at this company as the stock price falls further, because eventually, over the long term, if you're a long-term investor like me, I'm betting that in the next 5 years, the stock price is going to be substantially higher than what it's trading at right now. So I'm nibbling at the stock and I'm buying a few shares the lower it goes, because overall this company is a cash cow. On top of that, their overall revenue forecast is very good, while their earnings growth is arguably the most superior part about the company's health. But what about the overall valuation of a company? You should always look into the valuation and the market cap of a company to determine whether or not it's fairly valued, overvalued, or undervalued. Essentially, on this channel, we try to highlight growth companies that are undervalued, which gives us the greatest amount of payoff over the long term. We can do this by using various accounting ratios, such as the price to earnings ratio, the price to sales ratio, and the price to free cash flow ratio. For instance, we use free cash flow kind of to value Tesla's shares back when we did that story. But for Meta Platforms, they have fantastic ratings for their PE ratio, their PS ratio, and their P over CF multiple, which overall gives Meta Platforms an A rating according to Zacks Rank. And this indicates that the company is trading at a substantial discount from not only what it was trading at, but also compared to their overall competition and peers. That's why I am nibbling at this particular company, despite all of the negativity that is coming out about this particular business and their overall stock price. Lastly, we're going to close out talking about Amazon to see if Amazon is a good buying opportunity right now, because many professionals are screaming to buy it right now. It's sub $100 per share. Right now, the AMZN share price is $93 per share, while professionals believe the company is worth anywhere between $80 and $232 on the high end. Amazon, ticker AMZN, is most notably known for their overall e-commerce platform, but they also have a large segment regarding their cloud computing business. On top of that, just like Meta Platforms, Tesla, and SoFi, due to the negative macroeconomic environment, these companies are pulling back in price. Amazon has dropped over 40% year to date, similar to Tesla and Meta Platforms, which are all fantastic companies to hold and have in your portfolio. I would not advocate to sell these companies. Honestly, I'm doing the opposite, and I'm buying and nibbling more at these companies. The reason these companies are falling in their share price, particularly Amazon and Meta, is because they are firing employees to cut costs. On top of that, inflation is absolutely out of control, and investors' fear of a recession is causing them to liquidate their overall stock so they can have liquidity and money on hand. However, despite this, the company seems pretty strong. Now, this doesn't look like that on the surface because they are laying off employees and they're trying to scale back their expenses, but honestly, I think that's good for the company. The company should focus on lowering expenses and being very lean in the current stock market environment, which is going to set them better for the future. For the first 3 months, ended September 30th of 2022, the company has actually been growing by 15% year over year. So why is the company laying off employees? Well, the best part is that not only is Amazon still growing despite the negative macroeconomic environment we find ourselves in, but they're also cutting expenses, which in the year after or even in the next 5 years, that's going to reflect very positively on their earnings reports. So I would rather invest into this company early before it really starts to take off, because I am guaranteeing that I'm getting a good discount on the company right now, at least for the long term. Amazon is doing pretty amazing considering how it's generated growth across basically their entire business in the last few quarters, despite a very volatile macroeconomic environment. Again, this just shines on how stable this company is overall, which is why it is definitely in my top 10 investments. Just like we talked about with Meta Platforms, and similarly with Tesla, Amazon is currently trading at a PS ratio, or price to sales ratio, of just 2. This is extremely competitive, and if you are a long-term investor, it presents the opportunity to pick up some shares right now. It's definitely very tempting, but always make sure to do your own research, and that's going to be the latest news updates. And remember to go and smash that like button right now for more videos just like this one. Subscribe if you are new, comment down below your thoughts on any of these stories, and I will see you in the next YT video.